Welcome to S&P Capital IQ's December Loan Market Overview clip. I'm Steve Miller, a member of the Leverage Commentary and Data team. Over the next few minutes, we'll review recent market trends and discuss the outlook for the first quarter. In preview, the market's technical bias has improved since October. Loan prices, however, have been largely in the grip of global events, moving in sympathy with the equity markets. Participants generally expect this theme to persist until the situation in Europe stabilizes. In November, technical conditions improved slightly in loan land. The reason was mainly falling supply. The universe of loans outstanding shrank 0.5% in November as repayments ran ahead of newly funded loans. As supply waned, demand waxed. Though loan mutual fund flows remained in the red for a fourth straight month, outflows moderated to roughly $620 million, according to Lipper FMI, from nearly $1 billion in October. What's more, CLO issuance spiked to $2.5 billion in November, the biggest monthly sum in 3.5 years. These more bullish technical trends notwithstanding, conditions have stopped driving loan prices in recent months. Instead, the market has tracked events in Europe. In October, optimism that the EU would reach a deal pushed the S&P LSTA index up 2.9%, its biggest gain since 2009. In November, however, with the European situation eroding, the index traded off about 0.5%. The new issue market, by contrast, did rally in November as issuers took advantage of the scarcity premium in the primary. On average, new loans printed at 6.8% during the month, down from 8% in October. Adjusted for ratings, the decline was a bit less profound but still significant at 50 to 75 basis points. Looking ahead, players expect the market's slightly positive bias to persist in the near term. For one thing, the prospects for volume remain light, what with the forward calendar of M&A-related loans now at a 10-month low of $9.2 billion. For another, the amount of visible repayments is a bit higher at $9.4 billion. The wild card, of course, is which direction the animal spirits will take retail flows. Switching gears, credit conditions in the loan market remain as solid as Aaron Rodgers and the Packers' offense. The loan market default rate, in fact, fell to just 17 basis points in November, just wide of the all-time low from May 2007. Players expect the default rate to revert towards the mean in 2012, with the consensus estimate running at around 2%. That's where we've been. As for where the market's going, the outlook for the first quarter is even hazier than usual. It all depends on how Europe's debt crisis plays out, and as we know, prospects there are in constant motion. That said, there are two trends worth watching in the months ahead. First, the window for new CLOs is open again, if only narrowly. In November, for instance, volume jumped to a 3.5-year high of $2.5 billion as AAA liability spreads narrowed inside of LIBOR plus 160 on the latest deals from LIBOR plus 170 to 175 in October. If conditions stay as they are, participants expect issuance of $1 to $2 billion a month, mostly from large platforms that have the wherewithal to line up equity tickets. As for new issue volume, arrangers expect M&A-driven activity to remain light in the near term, with issuers instead refocusing their efforts on extending 2013 and 2014 maturities via amend-to-extends and bond takeouts. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description below. As well, you can download this presentation at slideshare.net. Finally, here's our standard disclaimer.